Welcome back. I hope you enjoyed our re-explanation of Go Dare and how we cycle the Go Dare themes through the show. You'll recall that in the last show we dealt with Fred and we dealt with John and we compared them to come up with the definition of wealth. That definition of wealth was R. Buckminster Fuller's, which was wealth is our organised capability to cope effectively with the environment as sustaining our healthy regeneration and decreasing both the physical and metaphysical restrictions of the forward days of our lives. Putting it really simply, we need to build forward days by accumulation. If we can't accumulate, we need to cover it with insurance. But there's another element of there as well, and that's health, and we'll pick up on that a little bit later. So we used Fred and John and we did a cycle every week in the program to just build on the story. We'll be doing the same in this series. We're calling it Flow of Money. Before we go too much further, a couple of items I need to deal with. Michelle, thank you very much for sending me 100 goals, but I got a new phone and I deleted them. So can you resend them, please? I'm terribly sorry. I need that so I can judge the winners of the iPads. We've got a few entries. I've been through some of them. Now, anyone who sent me 100 goals without nominating your best goal, can you please nominate me your best goal? Because that's the goal in which the competition will be judged. So at the end of this week, Michelle, I hope you do hear this and send them to me again. I'll wrap those best goals up and I'll send them to Keith Abraham and he can decide who's going to win the laptop. We'll let you know those people shortly. Also, the people who have won the risk assessments throughout the program, we'll let those know, and people who have won the books throughout the session, we'll let them know. So we're coming up to exciting times. As you know, in the first series, we tried to access the skill of advisors to try and simplify the concepts which you need to understand to create your own wealth plans. And what we said to these advisors was, who do you know who did and who did you know who didn't and how did it affect them? In this series, we're asking different questions. We're already familiar with Fred and John. In this series, we'll be asking the advisors, how would you help Fred and how would you help John? John and Fred, as we know, are both at totally different ends of the spectrum. If the advisor feels that the advice he offers in relation to these people couldn't be extrapolated to include everyone, I'll ask him to add a little bit for the person in between them. And in delivering the content this way, what we hope is that we're actually speaking to you. Doesn't matter who you are, we hope that somewhere in there will be a message that will resonate with you. And that's really what we're hoping to do. We're running a competition again in this series, and AIA once again have been very generous and have agreed to donate one iPad. So that's cool. You'll win this iPad by asking the best question on the blog on the website. So you may ask as many questions as you like. We'll have a judge, which I haven't nominated yet, and he'll judge the best question. The person who is nominated or judged as having offered the best question will be awarded the iPad at the end of this second series. This is towards the end of December. So keep looking, keep asking, get from the program what you need. Don't be afraid to come forward and ask. In addition to the iPad, AIA are also still generously awarding free risk assessments. So the weekly entry who is judged the best will get a free risk assessment, and the second best entry will receive Keith Abraham's book. So tons of things to stay involved for, and still a lot of prizes to win. I hope you get involved and win a prize. That would be lovely. We'll introduce the flow of money. It seems to me that if money flows correctly, you can create wealth. And I hope that you'll see through this series, which will be shown a couple of minutes in each episode going through the season, we'll build on something basic to something complex enough but simple enough for you to use. Now that we understand what wealth is, let's spend a little bit of time discovering what factors need to be created or controlled to accumulate sufficient wealth to provide an infinite number of forward days in your environment. An infinite number of forward days looks like this. The passive income from our investment matches our personal spending environment. We may need to modify the above model to take into account the following risks, which have the potential to drop the passive income below our desired spending. Inflation. If you invest $1, or more accurately nowadays $2.50, enough to buy a litre of milk, and this $2.50 grows to $50 in the future, I guess that you'd be pretty happy. unless of course a dollar of milk costs $55. So really, with inflation, money is only worth what it buys. Performance is another factor that can affect our passive income. Growth assets, property and shares vary in value according to the prevalent market. Although dividends and rental from these investments are less variable, they do vary. A company whose shares have fallen in value may choose to reinvest the money it would have previously paid in dividends or rental property may be unrented for a period. So ongoing income from growth investments, whilst less variable, is also subject to influences outside of our control. The final issue that can affect our passive income flow is regulation. Investors are always subject to the whim of government. A change in the rules relating to retirement or taxation may cause significant damage to income from investments. You'll remember it wasn't so long ago that superannuation payments were taxed, and it was Peter Costello who introduced the legislation that made all pension receipts from a super fund past age 55 free of tax. In fact, you don't even have to add them to a tax return. So to take into account these factors which we've mentioned, our model needs to be altered a little bit. It looks like this. We need to create an excess income from our investments. So our investments need to provide passive income which is greater than the amount we need to spend. This gives us an excess income which allows us to reinvest that excess income back into our investment, and in this way we are able to create a flow which should protect us against those factors we've discussed. As you can see, the passive income is slightly more than the desired spending. The excess is put back into passive income. It's used to increase the investment pool. This way you can protect income from most likely reversals. If we're able to build this virtuous cycle into our affairs, then we have managed to build indefinite forward days. This means that we no longer need to work to support ourselves. The only factor that remains is we have to be healthy enough to enjoy it. We'll talk about that after the break. See you soon.